This video might be the most single important video you will ever watch and the only trading psychology video you will need. This isn't no motivational or inspiring video that you see all over the internet because, again, the markets do not care about your feelings. And the reasons we have emotions is because we're emotional creatures. And how can we see that? How can we prevent these emotional and irrational decisions that we make every single day in the charts? And I will show you exactly that, right? Let's get right into it. Here are some of the books that I have read and some of the articles that I have found useful for me as a trader. And I will describe both these books in real time, how we can utilize our emotions and how we can prevent dumb decisions. Okay, so the human problem, we're emotional creatures, like I was saying. We don't want to be the bias, we want to see it. Okay, that's the whole point of this video. Let's talk about the two killers. The two biggest things that ruin traders is overconfidence and overtrading. Just because you have a good week, a good month, you're on a winning streak, you increase your leverage, you think, oh, you're better than you are, you think your strategy is better than it is, you increase everything, you start overtrading, and you will eventually fail, and you will lose a lot of money if you do this, right? So you're not better than the markets, you don't know more than other people, and you need to remain humble, right? So let's talk about overtrading. That happens a lot, big moves, fear of missing out, and it is the kryptonite. Depending on your strategy and how many trades you take, you need to stick to your plan and not do dumb things. Stop overtrading, all right? So that's the pretty obvious ones. Let's talk about more niche things that you didn't even know existed, right? Like extrapolation is the tendency to assume that the past performance or current trends will happen in the future. And we see this a lot and time again, especially with, certain strategies you see on the internet. Just because it worked for a month, just because it worked for a year, does not mean it will work for years. And in Wall Street, oh my God, traders and institutions are constantly changing their strategies, adapting to market conditions. So it makes no sense if you see a trader online doing the exact same thing year after year after year, the same strategy, 99 out of 100 times, their yearly P&L is not profitable or break even, okay? So we can see this time frame. Just because you think it's going to go up doesn't mean it's going to keep going up, okay? We need to realize that you're just seeing patterns in the markets with no data backing it. So your pattern trends, your trading patterns and all this stuff, you have no idea why, and you just think just because you've seen it before or this happened before that it's going to happen again. That's not the case. That's not how markets actually move, right? So again, apophenia. Apophenia is the ability of seeing patterns and randomness, and that's a lot of strategies right now. And eventually, if you flip a coin, heads or tails, heads you go long, tails you go short, eventually you will be profitable for a week, for a month, yearly, and on a long-term scale, you will not be. So a lot of times, and especially, on social media, you will see these strategies that these influencers are promoting, right? And when they have a good month, they, show and advertise their good month, but in reality, their yearly, their 2-year, their 4-year, aren't looking so good, right? Because it's all randomness. Again, like pattern trading is not how the markets move, and you will fail every single time. Whether you make one payout or you make two payouts, it doesn't matter. Whether you made 10K in 1 week, you will lose that 10K eventually, right? It will go right back to the markets because pattern trading isn't how the markets move. And in your head, oh, I've seen this before. Oh, because it took out this previous high and then broke structure, whatever you talk about, right? That means that it's gonna happen again and again and again and again. But you don't actually know that. And the markets are at random, right? So we're flipping a coin here every single time, and you think just because you were right one time, and that's why it's so easy to advertise these certain strategies, because they were right one time, they were right a month, even maybe 2 months. Now you've seen this and you're like, oh my God, it works every single time. And your head is stuck on the idea that no matter what, this is going to work. I'm going to make money off of this strategy, or I'm going to see this pattern again and go all in on it. And that's how people lose all their money. Okay. So let's get away from the randomness. Just because you see something happens a few times, even 10 times in a row, does not mean it's going to happen 11th. Okay. So that's the whole point. Loss aversion. Let's talk about this because this is very important. So it's the idea that every time you lose, right? Let's just say you lose $1,000. You feel that pain of losing 2 times greater than the joy of gaining $1,000. So you can see this graph, it literally talks about this. This is the same time period. So every time you gain 1,000, you get a certain amount of joy, right? But every time you lose, you feel the pain 2 times more. And that's just how humans are, okay? So we have to understand that. So when we lose, we don't go on tilt, we don't, miss out, and we don't overtrade because of FOMO right here, as you can see, the urge of everyone's in this move. I missed out on Bitcoin. Now I'm going to buy Bitcoin at 120,000 because I'm going on social media and I'm seeing all these people who are making a lot of money. Now I want to make money and I buy it and eventually I lose all my money because Bitcoin went down, right? And then anchoring. This is very important to understand. It's the idea that you're fixated on a price, right? So let's go back to Bitcoin. Let's just say Bitcoin was at $120,000 and you bought it at the dip at $80,000, right? And you think that was a good, smart financial decision. Eventually, Bitcoin went down. Bitcoin's at 60,000 right now, and maybe it even goes to 20,000. But in your head, you're looking at such a long time and such a long period that you still think, oh, that was the right move because eventually Bitcoin will go back to up to 80K. Bitcoin will go back up to 100K. Bitcoin will go back up to 150K. That's not the case. That is past information. If Bitcoin was never at 120,000 and Bitcoin only went up to 80,000 and you bought there, you would think it's the dumbest decision ever. But it's a psychological thing in your head basically telling you that you made the right decision because of past behaviors in the market, which is not the case. And you need to get that out of your head right now. And the worst thing about anchoring is what I've seen a lot of people is people want to, let's just say, have this number in their head. I only want to risk $1,000. So I'm going to move my stop loss. And if it's at 850, I'm going to move it a little bit down. Or if it's at, 1,000, 1,200 or like 1,200, I'm going to move it a bit up, to get that perfect $1,000. Well, the markets don't care about your whole numbers. So every time you move your TP to exactly $3,000 trade, and you're not, decreasing your leverage with that, you're just randomly moving it. That's how you fail. That's not a strategy. And every time you move your stop loss, your strategy is completely changing, okay? So stop doing that. The markets don't care about your whole numbers at all. They're going to move regardless, whether you place your stop loss at $1,000 or 850, right? Do what actually, stick to your strategy, do what actually makes sense in the time, do what actually you've been doing for years, and don't have these random number placements just because it's a whole number. People love these whole numbers, right? Like it's all about, I make $10,000 a month. What? What do you mean 10? Like the markets don't care about you making $10,000 a month. So that's why when I see these people online, I'm consistently making $10,000 a month in these markets. What is their strategy? How are they making exactly 10K, right? Like, how is that possible? It's not. Statistically, they're moving their TPs so they can get a whole number, which ultimately affects their strategy, which will lead to failure, right? Okay, so we can kind of see where I'm going with this and see how we can use these emotions to fully help us and utilize and become successful traders. So the book, Fooled by Randomness, it argues that luck plays such a more significant role than people are willing to admit, right? It's not your strategy. It's not because you've had all this market experience. Most of the times you have gotten lucky for the month, maybe even for the year. But eventually on a large time scale, your luck will run out and you will be unprofitable. And that's why we see these traders online that sell courses that don't promote their P&L, that will never show their P&L, right? Because they got lucky, they capitalized on their luck, which is good for them. They marketed themselves as good traders, and now they're selling 40K, 50K, even 100K a month in courses, and they're not actually making anything through trading, right? So let's go through what this book talks about. Survivor bias is focusing on winners, right? Focusing on the ideas that winners, right? For every winner, like I need to focus on what they did right and not what the losers did wrong, right? So for every successful traders, many has failed using the exact same strategy that you don't see. So your strategy might not be as good as you think it is. But you can see, if you focus on the one lucky survivor, you ignore all the failures, which now you're doing this strategy, even though 98% of people who have done this strategy completely failed, but maybe that one guy who got lucky, just forgot to trade on that Friday that most people blew their accounts, or just weren't following the strategy and got lucky, and now they're making a lot of money. Now you think, oh, wow, they're making a lot of money. Let me do that exact same strategy, right? Which is, you need to get that out of your head. You need to focus on everyone who does the strategy, and you need to have real data backing it, right? So another thing, alternative histories. You observe a certain path, exactly like you winning, and you don't see all the other paths of you losing. And this can happen, like, let's just say you have a strategy. You don't trade some of the days because you slept in. So you trade Monday, Friday, and Thursday. You slept in Tuesday, or you slept in Tuesday and Friday, right? So you trade Monday, Thursday, and Friday. You slept in Tuesday and Wednesday, right? So let's just say that week you made $10,000, and now you think because you made $10,000, it's because of your strategy. But because you didn't trade all those days, you could have easily lost the days that you weren't trading and blew your account, lost all your money. But you don't focus on that. You're only focusing on your success, which makes you ignorant going into the next week, which will ultimately lead to your failure, right? Okay, so noise versus signal, right? So like this is focusing on smaller time frames, and this is the reason why institutions laugh at us retail traders. We look at these small moves in the market, and let's just say we're looking for a breakout, and we want to go long, and we think, we're about to catch this huge move, and we see a little thing on a small time frame, a little move happen, and now all of a sudden we're getting a signal because we've seen it before using patterns, where again, there's been multiple times, but we're fixated on the times it was right. We're fixated on the pattern that, when this move happened, we made this huge move to the upside, right? And in our head, it's like, yeah, this will work every time. But we weren't fixated, or we weren't even looking for the times where, it made this small move, and it didn't go all the way up. It actually went all the way down. So we're fixated on randomness. We're fixated on pattern trading, which does not work. And there's time and time again to prove that, right? So again, noise versus signal. What is an actual signal? Maybe something on a larger time frame, maybe some macro events, right? Some news events that confirm our bias, and how can we put this all together, right? So we can go on the smaller time frame to confirm it, but we need to see on a larger time frame that, hey, this actually is the reason it happened, and there's a macro event or there's volatility in the market confirming our idea that it will go long. And we're not just looking for some random pattern or some random, it broke out technically because it closed above this high. That's complete nonsense. We need to get that out of our head, right? So the lucky fool, that comes in the lucky fool. They're right one time, and now they think because they're right one time, even maybe 10 times in a row, they're going to continue to be right. They're going to increase their leverage size. They're going to ultimately fail. So this book talks about, in 1998, the smartest hedge funds. I think there was a Nobel Prize winner, and they lost $4.6 billion in a matter of weeks because they were reckless and they didn't see macro events, and they followed their system again. So like they had the data, they had the algorithm showing that they were going to be right this percentage of time, and they stuck with it, not like changing that, hey, there's huge news events, the market is shifting, and just because you have 4 years of data doesn't mean it's going to continue to work, right? The market is shifting. There was crazy news events at the time, and they continued to be ignorant to those ideas, and they kept trading their exact strategy. They kept trading their analysis, and they lost $4.6 billion. And these were geniuses, right? So if geniuses are losing, what is the difference between you? Do you think you're better than them? Do you think you're more prone to winning? You need to stop being ignorant with that. You need to fully let your emotions go and just be focused on the idea that I know nothing, but I know all these things, and I'm looking in the past and realize, hey, this could happen to anyone, so I'm going to stay vigilant. I'm not going to overtrade. I'm not going to over-risk, and I'm going to constantly adjust my system and strategy depending on market conditions, depending on news events, depending on a lot of different things, right? So if you see a trader trading the exact same thing for years and years and years and years and on end, chances are their P&L on that 6-year time frame is not as good as you think it is, and could even be in the negatives, right? So we can see this on Instagram. The same trader, I'm trading the exact same way. I'm trading the exact same way. That's foolishness, right? That's fooled by randomness. They're the lucky fool that got lucky that 1 year and is now promoting their luck and trying to sell things based off of their one lucky year, their one lucky P&L, their 1 month that they've had, right? So that's what we need to stay away from. And you can see who does that, and you can see who doesn't, right? So let's talk about what, they talk about in the book, is the illusion of uncertainty, right? So this is exactly what happened with them losing $4.6 billion, right? So they thought their math, the math says this can't happen. Our algorithms, we've tested this 4,000 times, 4,000 different trades the past 3 years, right? So backtesting is extremely important, and you need to have data, but at the same time, you need to capitalize, and you need to realize when markets are shifting, when war happens, when panic happens, when politics happens, when tails happen, right? And you can have this idea that, especially, these hedge funds, like, when this happens, we're just going to take, all our money out of the market. And that's what a liquidity risk is, thinking that you have such a large amount of money. If you think you're just going to take all that money out, especially when a panic is happening in real time, when everyone else is taking all their money out, wow, that's not how that works. That's not how liquidity works, and you will ultimately be liquidized, right? So you will not be able to do that because you have such large capitals in the market, and everyone else is trying to remove. There's not enough liquidity in the market for you to take out, and therefore, boom, you just lost $4.6 billion. Okay, so again, black swan events, extremely rare, like COVID and a bunch of different things that happen more times than you can really predict and you can put into a model or their algorithms that they were testing. You can't test that. So that's why you need to be vigilant and look at the news every day and focus, hey, like, why did this huge move happen? What happened here? Like, you can't test some of these things, right? We just went to war with Iran. How can you test that in models and algorithms? It's very hard to. And that's why you have to be on top of the news. That's why you have to be on top of macro situations, right? So, and then using excessive leverage, right? So you can, if you increase your leverage size, eventually you could lose everything within one trade. You know how leverage goes. So moving forward, how can we, we got a lot of information right now. How can we fully embrace this information? How can we be successful in the future? Because you're just like, oh my God, like hedge fund managers lost 4.6 billion. All these people, if I backtest, it's not enough, right? Because these people backtested, they had data, and they still lost all their money. But if I don't backtest, then I'm fooled by randomness, and I'm just looking at the charts, and I don't know what's actually happening. And on a yearly time frame, I'm going to be a loser. So what do I do now? All right, you need data. So that's why you need data is number one thing. You need to fully be looking at the charts and seeing when these macro events happen. You need to be aware of every time you lose, it's your fault and not blame anything else. You need to embrace humility, like we can see right here, and acknowledge the role of randomness and the limits of your own skill. So let's just say you're a beginner trader. You've only been trading for a year. Don't think that you can do 4 strategies at once, right? Like the whole idea that you should only focus on one strategy is the dumbest thing ever. Because again, hedge funds and institutionals are constantly making new strategies and adjusting theirs. But at the same time, if you're a very beginner, you should not be going and looking at all these strategies when you haven't even mastered one. You don't even know why the markets move. So you need to understand that, humble yourself, or the markets will. Understand that you need data backing your strategy. You should probably not do strategies that everyone else is doing. And there's statistics and studies that they don't work, because if everyone's trading the same amount, again, retail traders volume is almost 35% of the market. So you can't even say, oh, but retail traders don't affect the markets at all. They do. That's just not true, right? So we need to focus on risk management, and we need to be self-aware and focus on our purpose, right? The goal isn't to be right. The goal is to survive long enough for your edge to matter. And when your edge doesn't work anymore, you need to shift and change either your edge or change how you perceive and think of these markets. Okay? That's just the facts. And I hope when you watch this video, if you made it to the end, I know this is a long video, that you understand all these different things. And eventually you will succeed and you will be right. So, right, the goal is to make money in these markets, but the goal isn't to be right. Like, we're not going to be right all the time. A lot of times markets move and we don't have a clue, but it's important that when those things happen, we can take a step back, look at it from a larger time frame, and be like, all right, I'm gonna focus on my system. I'm gonna focus on my risk management. When I am right, I'm not gonna think I'm the best ever. And when I'm getting social validation, this is for everyone that's on Instagram, on TikTok, on YouTube. They think, oh, I have social validation, right? I'm doing the best. Everyone thinks I'm the GOAT. And I can contest to this. I have a lot of people in my DMs thinking, when I have a really good week, people are flooded in like, oh, wow, like you're so good. Teach me all this stuff. But in reality, I don't know anything, right? I've been humbled by the markets many times, and I need to remain humble or I will get humbled, right? So again, find a strategy that works with you. Find something that not a lot of people are using. Don't be fooled by randomness. Don't look at these markets and look at patterns and think, oh, just because it happened before, it's going to happen again. Don't overtrade. Stick to your rules. Set your own rules. Don't listen to other people's rules, because every strategy has different rules, right? They have different rules, and you need to backtest and have data proving that. So some strategies, if you take one loss, you should be completely done for the day. With others, you can lose 2, 3, even 4 times I've seen with certain strategies because your RR is so high when you hit. But you need to realize when you are taking these trades, if emotions are too involved, emotions will always be involved. But if they are controlling your decision making, then you probably should be done for the day, okay? So if you do have a strategy where you're trading multiple times, but if you're chasing those trades and you're not actually making the right decision and you're not following your model, you need to realize, okay, wow, my emotions are teaching me, and I'm going off of my emotions more than I'm going off of my system in place. And you need to realize that. And that's, again, with risk management. If you're only risking a small amount of your portfolio, of your account, you won't be as tilted. But if you're risking 50% of your account, like full porting, obviously you're going to be more emotional about that trade. So how can we minimize emotions, stick to a system, and not be carried away by the noise? Okay, I hope this video has helped you. I hope you've gotten something from this video. I know this was a lot of information, but this is the only psychology video that you truly need. The rest, most of them on social media, on the internet, are nonsense, and they don't actually help you understand why you're feeling the way you do and how you can truly capitalize off of it. All right, bet.